Cash flow in real estate investing is overrated. Now I get it, I understand who doesn't like that mailbox money coming in on a monthly basis. But today I want to share with you a completely different perspective, something that completely changed my real estate investing approach. What's up guys, it's James Allen, the Out-of-State Investor, and when I first started learning about real estate investing almost 6 years ago now, I learned how I could utilize cash flow to retire early and even achieve financial independence. Well, I've learned a lot since then, and my approach has completely changed, which has allowed me to scale my real estate portfolio at a much faster speed. Now, before I go any further, let me just stop you right there. Go ahead and smash that like button to support the channel. And if you haven't already done so, you got to subscribe and hit that notification bell for more content like this. And with that said, let's jump into it. Now, like I said, I started learning about real estate almost 6 years ago. I started with a Cody Sperber Clever Investor course that I paid for. I paid about like $500 for that course. And I took that course and then I ended up finding bigger pockets. And so I just started consuming everything they had. I would read their books, I would listen to their podcasts, I would read their articles, of course, in addition to some of the other resources I was utilizing. But Bigger Pockets was right at the forefront of one of the biggest parts of my real estate education in the beginning. Now, one of the biggest things they would always talk about is cash flow. What is your cash on cash return? What's a good cash on cash return? What's a bad cash on cash return? And I remember Brandon Turner, who's like one of the biggest people in Bigger Pockets, would always say he's getting a 12% cash on cash return on his investments. So I remember thinking, if I didn't get a 12% cash on cash return, then I must not be doing very good. That must not be a good investment. If I get a 10% return, maybe that's not worth going after. Well, as I kept learning about real estate, I started to understand that there was another part to real estate that was just as important, if not even more important than cash flow, and that was appreciation, something that they didn't really talk a lot about at the time. You see, cash flow is nice because it gives you that mailbox money every single month and you can use it to even replace your income down the line, but appreciation builds massive wealth and it gives you the ability to scale your real estate portfolio much faster than you can with cash flow. And I remember whenever I'd speak to some of these old school real estate investors, they'd always tell me that the way they made their money was focusing on location, 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 and that appreciation is what really built their wealth for them. So that's why I never really got on the 100% cash flow train, because as you may know, when you're choosing a market to invest in, you can go for a market that's like pure cash flow play, you can go for like a pure appreciation play, or you can go for something in the middle that's like a combination of cash flow and appreciation. And that's what I like to target, is that combination of cash flow and appreciation. So I'll tell you the strategy I've used since I got started in real estate investing and that I continue to use to this day, and that's that I want to invest in a market where I can get a 10% cash on cash return, but I can also be primed for good appreciation based on the quality of the market and the quality of the neighborhood specifically that I'm investing in. So for instance, I currently invest in the city of Knoxville, Tennessee, and if you check out neighborhoodscout.com, it's a great website where you can see historic appreciation. Over the last 20 years, the city of Knoxville, Tennessee has averaged over 3% annual appreciation, which is pretty cool because it's actually over the average appreciation nationwide. But what I really like is that in addition to that above average appreciation, I'm also getting pretty good cash flow. Now, it might not be really good cash flow like you might find in like a Cleveland or Memphis or markets like that, but what it does do is it primes me for pretty good cash flow and above average long-term appreciation. Now, in addition to that, I like to target gentrifying areas. These are just areas that are rapidly changing. I like to look for where the local flippers are flipping at, and I like to find out where the city is investing their money into new redevelopment projects. Some investors would refer to this as the path of progress, and that's really where I like to put my money into when I'm investing in real estate. Now, because of this strategy, I've been able to experience some rapid short-term appreciation on a lot of my investment properties, and in addition to that, they cash flow well and they're positioned for good long-term growth because they're in an above average appreciating market. In fact, my first real estate deal that I ever did gave me the opportunity to purchase more deals and do more rehabs, which essentially let me scale my portfolio much faster than I would have just on cash flow alone. And a large part of that was due to the fast appreciation I got targeting gentrifying areas. Now, had I gotten 12 or 15% cash on cash return, just pure cash flow in a lower appreciating market, it would have been a completely different story. You see, let's say you had a cash flowing property that put out $400 a month after all expenses. After 1 year, you'd save up $4,800. Not bad. After 5 years, it would take you 5 years to get to $25,000 to where you might be able to get another property. Whereas in this situation with my first real estate deal, I was able to turn $18,000 into $60,000 in just a matter of over a year. So that's the main part of my investing strategy, but there is another part of my investing strategy that I've recently been adding over the last few years. I like to take advantage of my primary residences, and what I mean by that is I like to essentially live in a primary residence for about a year or two. I like to move out. I hold on to it as a rental property. I rent it out and I buy another property with very little down out of pocket. Now this is really more of an appreciation play, but these properties do completely sustain themselves and then still maybe give me a little bit of cash flow each month, although it's probably a very small amount, at least in the beginning. But long term, I'm positioned for great appreciation both in price growth and in rent growth. So with these types of properties, I'm targeting areas that essentially I want to raise my kids in. So you're talking about areas with low crime, with good schools, with amenities nearby, and those are the driving fundamentals that are going to give me that long-term price growth. And the best part about this is I can get into these houses with as little as 5% down. Now, if you're just doing it for the first time, you can get in with as little as 3% down. But what that means is that on a $400,000 property, a 5% down payment for me is going to be only $20,000. Yet in the last year, the Phoenix market actually experienced 25% growth year over year, which means that I would have made about $100,000 in equity on that $400,000 house. Now that's hundreds of percent return on investment on my $20,000 down payment. Now obviously it's not going to do 25% every single year, but even at 5%, which is almost the average with the Phoenix market, at 5% on a 5% down payment, that's a 100% return on investment. Now in addition to buying these primary residences, I like to target the kind of houses that need a little bit of fixing up, a little bit of updating, because then I can add some value to the property and also get top dollar rent. So naturally it's going to lower my return on investment because I'm putting more money into things like the rehab, but at the same time what it does is it gives me a little more safety net because I got better cash flow, and in addition to that I got extra equity because I added value to the property, so I could do a cash out refinance, maybe get some cash in my pocket, eliminate my private mortgage insurance altogether, which is an extra added monthly cost you got to pay, or I could go the HELOC route. Now imagine if you were to build your portfolio by just simply keeping your primary residence instead of selling it, getting it rented out, and it can completely sustain itself and even cash flow. It's not going to take you that long to get to say a $2 million real estate portfolio, and you can imagine that if the housing market had a good year where it appreciated 10%, well that's $200,000 of net worth added to your bottom line in just 1 year. So you can see how scalable that can be, and the way I'm able to mitigate the risk with these properties is I have my out-of-state properties that are able to give me additional cash flow because they cash flow a lot better than the primary residences, and then in addition to that, of course you got to have your reserves in place. But as much as I'm talking about cash flow being overrated, in reality cash flow really is the long-term goal, because once I get these primary residences appreciating for me over the long run, there's going to be one day where I'm going to cash out, I'm going to sell them, use a 1031 exchange to defer taxes, and throw all that money into cash flowing apartment complexes. So that's really my end goal, is eventually I do want cash flow, but at least for now what I'm focused on is trying to acquire as much real estate I can in a safe way, so where I can experience great appreciation, and down the road I'll end up getting way more cash flow than I would if I just focused on cash flow from day one. So anyways, this is my strategy. This is how I approach real estate investing these days. I'm definitely looking for those markets where I can get that cash flow and appreciation, also utilizing my primary residences to get massive long-term gains with appreciation, with the end goal being massive cash flow into apartment complexes. But anyways, I hope you guys enjoyed this video. Hope you gained some value from it. If you did, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below, how are you approaching your real estate investments? What's your real estate strategy? Finally, follow me on Instagram and TikTok at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.